Cliff Tan, East Asian Head of Global Market Research at MUFG Bank, joins us right now. Cliff, good having you. Thanks so much for joining in. It's very topsy-turvy because the US futures are in the green and therefore Asia is not reacting as badly as one would have thought. What is your sense? How does the near term shape up?
Well, I think today will probably be some sort of a technical rebound. You can see it in the currency markets. You can see it, as you mentioned, in the equity futures. Now, what the rebound is based off of, besides price action, is very difficult to see. We felt for some time, and we still feel, that the markets are still not fully appreciating the full force of this disease outbreak on global aggregate demand. I think what they're starting to price in the last couple of days, last week and then also, of course, yesterday, is that there could be an aggregate demand shock hit not only to China that ripples out across the world, but it could hit other places of the world and ripple back into China and other places. So people were not counting on that. I think they were extremely short-sighted because I don't think it would have taken a lot of imagination to, based on what we've known of past epidemics, to expect to see some of what we're seeing now. I would say that certainly there's a premium for calmness right now. I mean, we are still expecting this episode to eventually be over, say, by late April or early May. But, that's a hypothesis that we need to test every day. And in particular, I would say that the rebound today is a statement that the more industrial countries will have greater success at containing the spread of this disease than China has had. I hope so. I hope they're right. But I think right now we don't know enough about the disease to make that kind of conclusion yet.
Okay, fair point. Cliff, the one argument being made is that, because of the advent of summer, the disease hopefully will get contained and all of that, and therefore the optimist is saying that the economic impact, while unpredictable, would be there in the current quarter, will not necessarily last with the same impact in the quarters to come, and therefore because markets look at the future, they will discount the present very, very quickly. Is that a reasonable argument, or is the economic impact so difficult to quantify right now that markets are underpricing it?
I think it's a reasonable argument if you could have certainty about the boundaries of where the disease is going to hit. I think what we're seeing right now in Europe, and in some of the Middle Eastern countries, is that we're seeing the same kind of, this type of shock. The main effect is to keep people from meeting face to face, and that that's a shock for everybody, no matter where you are in the supply chain. And so, if this is the kind of reaction, the kind of natural reaction that you would get to an outbreak like this, we're going to have aggregate demand weaker in Europe, in the Middle East. And as I said, I think what people were counting on was that, well, China will get over it, and then it'll start producing again, and the supply chain will get back into traction. But what if, the places that you sell your goods to also have aggregate demand down shocks? That's not something that I think people have fully priced in yet.
In which case, Cliff, my final question. We've seen some of the commodity prices across the world come off quite rapidly. Do you reckon they'll stay lower? Crude, base metals, the likes?
I think logically they should stay lower. They were actually, as you may know, in the last couple of weeks, kind of making a bit of a recovery from the first shock. But I think that recovery is going to be aborted based on what's happened so far.